Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Jack Miller, Head of Global Execution Services at Baird, Shehryar Khokhar, Manager of Global Perception Americas with Nasdaq Corporate Solutions, and Chris Dearborn and Max Cabasso, Managing Directors on the Nasdaq Market Intelligence Desk. We're here to discuss the impact of T+1 and how institutional investors perceive liquidity in the marketplace. It is great to have everyone with us. Welcome back to the show, Jack. Great to see you.
Thanks for having me.
And let's kick it off actually and talk about market resilience. It seems to be a pretty timely story here.
Yeah, definitely. And I think if we kind of look at the narrative of the last, call it 4+ years, we've had some pretty significant volatility events just in the world that have had an impact on markets. So think about the COVID pandemic, think about round one of the meme stock craze, things of that nature. I think what was interesting, what wasn't a story throughout all of that was issues with market failures and things of that nature. I mean, it's amazing how resilient the U.S. equity markets have been throughout all of that. And I bring that up just because just this week we had a couple blips in the last week or so. Three things that I could point to that impacted markets related to market data, and it just so happens to have happened a week after we made this transition to T+1, which has introduced a couple interesting follow-on impacts.
Mm-hmm. Oh, do you think that any of those data glitches were specific to T+1, or it was exclusive of that?
No, I don't. I think it was just happenstance that it happened to happen at that time. But what it did do, and it ended up not being a material issue, but what we realized is, well, now we have one day less to resolve any errors or issues that would have come up as a result of those trades. So you have Berkshire Hathaway printing at 0, waiting till the end of the day to figure out if those trades are going to be busted. We assume they would, but that just put the whole post-day processing on hold, and now with only one day to take care of that, just created a different set of issues for the operational staffs out on the street.
Yeah, and Shehryar, it's interesting because you're out of our Toronto office, so welcome to New York, welcome to Market Site. When you're talking to clients in Canada, or as you're thinking about market structure, what happens here in the US, is it impactful? What kind of questions are they asking you as it relates to either T+1 or how market structure is evolving, how it's impacting their companies, their portfolios?
I think it's a lot of, how efficient is the market going to be longer term is the key question everyone keeps asking, right? I mean, one of the aspects of the blips is how quickly can you resolve those issues? How quickly can you resolve a particular impact on a longer term basis? If you look at T+5, that was a great element where you had enough time to resolve those elements, right? So it does pose a unique thing for corporates where they don't necessarily want to see that prolonged or have a protracted impact for them. And on the institutional investment side, where we do a lot of work with those folks, it just causes a lot more havoc for them to understand how that's going to place on their trades, right? So for them, on an institutional perspective, that's where it's challenging. But I think with the movement towards AI and with the movement towards those market technologies and a lot of investment in those areas, that's where a lot of focus is going forward in terms of market structure. And a lot of it is advising on institutional investment and into that sector and how that's going to play out longer term. If you look at the M&A market over the last year or two, a lot of the focus for institutional investments have been a lot more on a strategic basis, with the only growth drivers being in technology in that avenue. So a lot of the concerns are how is this going to play out in a longer term, to what degrees are going to create market efficiency or inefficiencies, and how much of that can be resolved quickly.
Which is interesting because it's not necessarily organic when they're thinking about their M&A strategies. It could either be divesting or acquiring a company or a piece of a company to further their plans.
I mean, if you look at M&A sentiment more broadly, taking a step back, it's a downward trend across all sectors. The only growth opportunities you're looking at is mainly in healthcare and in technology, and in some infrastructure spend as it relates to utilities and energy. So that's broadly the themes in terms of investor sentiment, in terms of where capital should go on an M&A perspective, but it's still a relatively bearish market. Across other sectors, it's a lot more of a strategic function now in terms of how M&A should be implemented longer term. So it's not something that is a key priority area for investors. They don't necessarily want to see corporate issuers spending too much of their time focused on large swings or inorganic growth just for the sake of it. A lot of it is around just making sure that you have a very strategic practice in place where it's going to accrete very quickly, or if it's meant for infrastructure spend in energy or for infrastructure spend for AI, more transformative projects that help benefit the company's organic growth profile.
Yeah, it's so interesting, Chris and Max. with the companies that you speak with the U.S. listed Nasdaq companies, it seems to be if you're investing in your tech stack or thinking about energy demand, you're kind of getting a pass there. But really, it's that breadth really hasn't quite spread out just yet. When we're thinking about how stock performance or in terms of IPOs and what's coming.
Yeah, again, it's the trade we've continued to talk about, and the knock-on effects is AI. How is it going to relate to that? You seem to be getting a premium for that sort of acquisition or investment into your spaces if it's going to enhance those capabilities for your company. Like you said, anywhere else where you're kind of getting dinged for it. And again, it's just really that kind of knock on where you're going to allocate your capital and how are investors going to react to that. Because again, what is this going to do for the future, and how is this going to enhance those capabilities where everybody's going to AI? In the trade we talked about, even with utilities and for energy and powering AI, everything seems to be related to that kind of tech stack of what's the return going to be, versus kind of outside of that landscape where again you're really getting dinged for it.
I mean, Chris, wasn't utilities the top performing sector?
It's one of the best performing utilities on the ancillary trade.
Right.
Because you need, if you're going to be developing AI chips and products, you need power. And think of it on the same way as when Bitcoin first came out, right? The blockchain was a hot item. Anybody who said anything with blockchain, it really took off. I mean, you have a Nasdaq traded company that made iced tea and they put blockchain at the back of it and it took off, right? So AI is definitely here to stay. It's a little bit different. Hopefully, on looking at settlement and how things move, eventually I'd love to see 0 days and using blockchain technology to actually work that happen. So, but Jack's point, right now, going back to some of the glitches, what we have right now on a T1, we haven't seen any of the failure data on settlement yet, and that'll come forward to see how well the back offices were prepared for this. And there's always going to be a lag for that. There's going to be definite failures, and there's going to be settlement data that's not going to hit. But that'll work itself out just like everything else does. The market's being resilient to the other point of it. The money has been flowing into the winners, right? The Nasdaq 100 just made another new all-time high today. The S&P is right there. All the majors made index highs last month, and we're going to make them again this month right now. And when you look at the liquidity, you want to put money into that winning trade, whether you're short-term or you think towards the future. That's why the tech companies get the higher multiples that they do, where consumer companies are starting to trade down because the consumer is starting to fade a little bit here. So when you look at the haves and the have-not, the money's flowing into tech, the money's flowing into utilities, then anything that's going to be supporting that at the moment, and people are taking that out of the other areas.
Yeah.
And that's why you've had the build in copper and the other products that go into that infrastructure build, which is, Dr. Copper is trading at all-time highs again last week. Gold is trading up as well. With all the geopolitical items, markets shouldn't be here where we are.
Sell in May didn't necessarily play out.
No, we bought in May.
But speaking of liquidity, I want to shift it back to the market structure conversation a bit here. Jack, and I think this has been another hot topic. What's the experience of institutional investors today when they think about liquidity profiles?
Yeah, well, I mean, obviously a topic near and dear to our heart as a service provider to institutional investors, but it's still tough, and I think we continue to see this disconnect between just the headline numbers of volume and what the perception of liquidity would actually be. And there's been a number of, well-documented reasons for that, whether it's the rise of retail and off-exchange trading, further fragmentation of liquidity, and then also the movement of liquidity during the day towards the close in those last few minutes of the day, which just sort of has hollowed out the liquidity profile in the middle of the day. And I guess just one comment on fragmentation, that's kind of a boogeyman word that we like to talk about. It's a bad thing, but on the other hand, the kind of nice cousin of it is segmentation. I think we're all trying to control in a way, who we're dealing with and how. And there's been quite a bit of innovation in the marketplace in terms of new order types, new ways to control our experience, whether on exchange or in ATSs. That has generally been a positive, but the dark side of that, of course, is now much more complexity and much less bunching of liquidity that has created some challenges for our clients.
Yeah. Well, Chris, let's carry this further. What is the difference between volume and liquidity? Because Jack's point, you hear about
terms.
volume all the time.
It's two different terms. We just had a call with an issuer we were talking about beforehand. The company has a higher price point, trades north of $300, but the majority of their trades on a day-to-day basis are odd lots, less than 99 shares. By SEC rule, odd lots do not change the price of the stock on the consolidated tape. You need a round lot figure or more. So When you talk about volume, the stocks, we traded 15,000 shares, 20,000 shares, 150,000 shares today, which all the volume goes into, but how much of that liquidity was actually moved to the price point? How many shares were round lots? Right. That's why when you see a lot of institutional shares trading in an equity, it's based in the first half hour, sometimes extended a little bit past that, so from 9:30 to 10, maybe 10:30, depending on how liquid the stock is at that moment. And then in the final hour, really accelerating into the last 10 minutes right before the close, because everyone's in the market, those price points, for whatever their investment thesis may be, whether they're short-term traders, day traders, market makers, institutional, what have you, and the spreads start to tighten. So that's where the difference is. What is my basis point for exit and entry, and how much alpha can I capture based off of that, as opposed to price slippage and loss of alpha intraday when a stock price may be 50, 60 basis points wide. That's why institutions don't like to trade. That's why they go into dark pools intraday, unless they can find liquidity and you got to go paying for it, or have your sales traders reach out, the guys, and try to find the other side of a block trade. They come into the markets then. So when you look at the consolidated tape, the average volume prior to this was about 11 billion shares, 7 billion shares, sorry, before COVID. Now we're averaging closer to 11 billion shares on the consolidated tape. So when you look at that, how much of that volume is retail? A lot more now because of zero commissions, right? The Robinhood effect is taking the part of that, and the day trading part of it. So the liquidity there, the volume, is attributed to the day traders. A lot of it goes to the higher end stocks. A lot of the tail of that, majority of the stocks that are listed, are not the Nvidias, the Apples, and the Amazons of the world.
Well, sure, it could also be argued too because of the rise of indexing strategies as well, right? I mean, that's certainly going to lend to more volume at the close. I mean, we were joking around. Right, we were joking around on the desk earlier in the day. I'm going to ring the midday closing bell, but it's because of these different strategies, using indexes.
I also think that plays into performance. Small cap, we've talked about the underperformance small caps versus large and mega caps, and institutional investors following the trade that's working because they can get in and out. You can trade that, you can take your money out, because again, I just had a company here, small cap that I was speaking to. The biggest concern that they hear from potential investors is, we're happy to be buyers, but if we have to sell for one reason or another, there's a redemption, the impact they're going to have, they're not agile. You can't get in and get out without making a big impact on the stock, which is going to hurt your P&L. So following that trade to, okay, look, I can get in and out of these mega cap stocks, I can put on a good size position for my portfolio, and it's not going to make any impact on the stock. But small caps, the liquidity's not there during the day. I have to trade at the end of the day. That's why I see a lot of bigger moves end of the day in some of the small caps, because everything is going into the close. It's hard to build out a position, and even harder to exit a position during the day. So it's just a lot more difficult to put money to work in those small caps, because you're worried about, when I'm trying to monetize this, what's the impact going to be?
Yeah, I think on position sizing, that's a unique problem for corporates, right? So when you're looking at how they would like institutional capital attraction to take place, they're not necessarily focused on retail or the trading element. They want longer term holders that are coming into the stock. And the challenge on a small cap perspective with the efficiency is, how is that going to create an environment where I can sustain capital attraction for a longer period of time when I have a promising stock performance, right? When I have promising fundamentals, which is where the street's mainly going when it comes to overarching sentiment across different sectors. And it varies, I suppose, but generally speaking, the focus is more so, consistent organic growth, but more diligently applied right now. And when you're looking at how volume will come into the stock, you want it to be sustained on a corporate perspective. So it's a unique balance in terms of how people are going to be attracting capital on a longer term basis. And it's a unique challenge for corporates that are actually performing very well in the current market conditions. So that's one of the unique challenges on a performance basis.
I mean, the have and have nots, right? If you're cash flow positive, investors are going to find you, but 40% of the tail of the Russell 2000 is cash flow negative. And you see some of those that are happening in the stocks. They don't trade. When they do, people are exiting. And again, questions we get from clients are, why is my stock trading down? It's a simple question with a very complex answer. Liquidity is definitely an issue, right? And as you see, if I made the entry, it didn't work out, I need to exit because of whatever reason it may be, who's going to be buying that stock? And if that liquidity is not there, you're going to see the price slippage, which goes to institutions, which is why you see so much money flowing to the passive funds right now, because you're capturing a significant amount of the market structure and how the overall is running, because depending on the index you're in, the Russell 1000, the S&P 500, you're going to be capturing it. And if you decide to go a little bit smaller, the Russell 2000, yeah, it's acting better, but the majority of those companies are cash flow negative and underperforming the market. And the divergence right now that we're seeing at the top of the market to the bottom is significant. You know, you've got 7 versus 493 in the S&P 500, you know, that's carrying it through. So it's a tough question, but
easy question, complex answer.
right. It's a tough question to answer with an easy. People want you to put it into a bullet point.
Right.
You can't answer it in a bullet point.
Right. Well, I mean, Jack, to your point before, and I want to wrap up here with some regulatory conversation.
Sure.
How is the SEC thinking about this? What problem are they trying to solve when we, think about these anomalies in the market, like the meme craze as an example?
Well, I mean, interesting to come back to something you said, Chris, about the SIP and what actually prints to the tape. You kind of go all the way back before the Gensler proposals to the last administration, and there was, regulation proposed to modernize the tape itself. And then interestingly now, years later, we actually have a market data issue that has created some problems. So maybe that does shine a light on sort of, well, what are we trying to solve some of those problems? Let's get odd lots out on the tape. Let's have a truer representation of what the market actually is. And let's, introduce some different ways or reasons to improve that product rather than just having the basic 3 SIPs that we have today.
Right.
I would also imagine too, I mean, here you are service providers as firms buy sell side where you're promising best X and being able to get in and out of positions, and everyone is saying here you can get in, but it's challenging to get out. You're just not getting executions. I mean, that's an industry-wide issue that needs to be addressed.
100%. Yeah, that is the problem, and anything we can do to make that challenge easier for our clients, that's what we should be focused on.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.